All right, guys, let's try this again. I was working on this lesson, on recording it, and I was about two-thirds of the way done. And unfortunately, it disappeared on me. So let's pull it back up. If y'all remember, if you've done Monday's lesson, we're talking about the Federal Reserve. It's not the most exciting thing, but financial policy is a very big element of the federal bureaucracy. I mean, it's just a huge part of the federal government in general. And the Federal Reserve, some people like this, some people don't like it. They play a large role in determining our fiscal policy and in manipulating the markets. So we're going to pick up. We made it through a lot of this yesterday, but we're going to pick back up where we left off, and we'll likely finish this lesson today. This PowerPoint. If we finish this PowerPoint, I've got something else I want us to look at. But we're going to go ahead and get started as soon as this loads up for me. I'm going to present it. I hope everybody is doing well and is staying safe. Be nice to your parents, your siblings. Hope your classes are going well. I think so far this has gone really quite smoothly. So let's just keep it up. Come on, buddy. Now, eventually, this week, we're going to start talking about local politics. We'll be talking about local and state politics. So I'm going to need this thing to go ahead and get going. Local and state politics, when we get into that, that's a really interesting unit because most of us don't realize what a big deal our local and state politicians are. And something like that is especially evident now that we're dealing with this crisis, this COVID crisis, because governors and mayors are being asked to make very difficult decisions. So those are local state politicians who really are having, in some ways, a greater impact on us right now than the president and the federal government. So um, let's try this again. We're just going to go through it. We won't, in the interest of time, we're not going to worry about actually getting it to present. We'll just go through it like this, if it'll work for me at all. Come on, buddy. Do you guys remember talking? They have the region and the unit and all of that stuff labeled on the dollar bill. I thought that was interesting. But enough about that. Ay, ay, ay. There is a movie about the Federal Reserve called Money for Nothing that if you guys just really, really are struggling to find something to do, you might find it interesting. It's about the Fed, some of the criticisms people have of it. Um, All right, come on, buddy. We'll be talking about the four tools of monetary policy. Just to give you a hint, that is definitely you're going to be asked about that on today's summary assignment. So I'm taking a chance on this and hoping that it'll load for me this time. Um, there we go. So the Fed, it has three major functions. It ensures that currency, check, and electronic transfers of money are safe, secure, and efficient. That's one function. Currency distribution. The government prints currency and the Fed distributes it. So remember, the Treasury is the one that prints it, the Fed is the one that sends it or that distributes it. There's an automated clearinghouse, they call it the ACH, which its purpose is to clear electronic credit and debit transfers. That includes writing checks. Checks are becoming less and less prevalent in our economic system, but they still do serve an important role. And FedWire. So ACH clears a lot of money. FedWire clears much, much more. FedWire is what allows financial institutions, banks, to settle payments electronically and immediately, as opposed to having to send a check or transfer cash or something like that. So the ACH that transfers billions of dollars. The FedWire transfers trillions, and the government's fiscal agent. It acts as the government's bank, basically. Remember when we first were talking about the establishment of banking in the United States, we talked about how Alexander Hamilton created the first national bank, and then eventually that lapsed, that expired. The charter did, and they formed the second national bank. The Fed isn't exactly like that, but it does function in that way, and that it's basically the government's bank. It maintains a bank account for the Treasury, collects tax deposits, and it processes government checks, securities, and money orders. The second major function of the Fed is to supervise and regulate financial institutions. This ensures they're run safely and consumers are treated fairly. So, financial supervision and regulation is a major role for the Fed. They conduct something called the bank examination. The purpose of that is to assess the quality of a bank's capital, assets, management, earnings, liquidity, and risk. They review the quality of the bank's loans using the five C's. The five C's are capacity to repay, collateral, condition or circumstances, capital, and character. That's also going to be featured on your follow up assignment. So make sure that you're watching. So supervision and regulation, and that is based off of uh, the five C's, as we just said. I love it when they break it down into something like that. capacity to repay, collateral, condition or circumstances, capital, and character. They also enforce the law. There are two laws in particular: the Truth in Lending Act and the Community Reinvestment Act. The Truth in Lending Act requires people providing loans to be more transparent or to provide the necessary details when providing that loan. And the Community Reinvestment Act, the purpose of that is to say that banks cannot exclude loans to people with low income. Now, people with higher income can certainly get more favorable terms on their loans, and it is very true that some people in low income scenarios are unable to get a loan at all. But the Community Reinvestment Act, at least the purpose of it, is to prevent banks from excluding loans to people with low incomes. Also, the Dodd-Frank Act, which provided for additional supervision at large financial firms. That one we got in 2010 because the recession of 2007 to 2009 showed us that we needed more supervision. Our bankers needed more supervision. Um, a third major function of the Fed is to conduct monetary policy. This means that the Fed alters the money supply to promote economic growth and stability. And when we say alters the money supply, we mean that. They actually are the ones who are determining how much money is on the streets. The idea being to promote economic growth and stability. That's pretty self-explanatory, right? So trying to keep prices stable and to maximize employment. There are four tools of monetary policy: open market operations, selling or buying government securities, discount rates, interest rates on money borrowed from the Fed, reserve requirement, ratio of bank deposits kept as reserves. These are, and then number four, interest on reserves. So these are things that the Fed can use to affect the economy. Elements of monetary policy that tools, I guess, is the better term that the Fed can use. We will not do this class activity because we're not in class, but it was a good one. All right, let's quiz ourselves, shall we? We ready for this? First bank of the United States, second bank of the United States, the free banking era, the national banking era. The first bank, remember, that's the one made by Hamilton. The second bank had to be made after or was it lapsed during Jackson's time. The free banking era is when the federal government got rid of their bank and gave banking privileges to states and to independent banks. And then the national banking era is really when the Civil War rolled around, and we realized that did the federal government realized that they needed a bank. So there we go. First bank of the U.S. Alexander Hamilton was the brains behind the establishment of this central bank. Second bank of the U.S. Due to the controversy surrounding this central bank, Andrew Jackson succeeded in allowing it to expire in 1836. The free banking era where there was no central bank in the United States, and currency was issued and backed by individual banks, a lot of them at the state level. In the national banking era, during this time, a law was passed that financed the Civil War and allowed banks to issue a uniform currency. All right, guys, let's keep on going. I've had to pause it and start it back up a lot today, so I apologize there for the lack of continuity. I know you guys have come to expect nothing if not smooth transitions. So we're on slide 56. We're just about through with this one, so we will finish this and then we'll take a look at something else, and then we'll call it a day. The members of the Federal Reserve Board of Governors serve one 14-year term because the district bank president, who always gets to vote on the Federal Open Market Committee, is from where? Prior to the Federal Reserve System, the nation's financial sector suffered from a lack of blank. During the Great Depression, the Federal Reserve realized that it needed to blank. Every day, financial institutions transfer trillions of dollars using the Federal Reserve Service known as blank. And one of the main ways in which the Federal Reserve supervises and regulates the banking system is to blank. I think we should all know this at this point. Why do they serve only one term, and why is that term 14 years long? Well, the 14 years is somewhat arbitrary, but the fact that they only serve one term is very much deliberate. And the idea is that where it says it insulates them from political pressure, what I mean is that they can make decisions without the fear of not being reelected, because they're not eligible to be reelected in the first place. Similar to a similar concept to Supreme Court justices, right? Those are not 14-year terms. Those are lifetime appointments, but still, the whole concept is that they would be free to make decisions based off of what was best for the country, as opposed to trying to look out for the interests of just their supporters. The district bank president, who always gets to vote on the Federal Open Market Committee, the FOMC, is from New York. New York is really the financial center of America. It's where Wall Street is. It's just really New York more than any other city, I would say, is associated with finance. At least any other city in the U.S. Prior to the Federal Reserve System, the nation's financial sector suffered from a lack of blank regulation. Remember, we used the term laissez-faire. It was pretty much the Wild West, and banks and investors had a lot of freedoms, but really freedoms that went beyond um, what was appropriate. It set the stage for disaster, basically. And that's an issue that is going to come up again, or that'll be a criticism that comes up again in 2007, during the 2007 recession, because people will say that the markets, specifically like the mortgages, were not being regulated to the extent that they should have been. So that's not a new debate. The debate over how much regulation is just enough and how much is too much. During the Great Depression, the Federal Reserve realized that it needed to increase bank regulation and conduct monetary policy. So they saw during the Depression what the effects of this lack of regulation was, this financial chaos. They saw the effects and they realized that they needed to prevent it from happening. To hopefully prevent it from happening. Looking at number 9, every day financial institutions transfer trillions of dollars using the Federal Reserve Service known as blank. That's FedWire. Remember, the clearinghouse clears a lot of money, billions. The FedWire is clearing trillions. So the impact of FedWire is greater than that of clearinghouse. And why is that? Because that allows banks to transfer money to each other electronically, basically instantly. One of the main ways in which the Federal Reserve supervises and regulates the banking system is to blank. They perform on-site and off-site bank examinations. Remember, using the 5 Cs as one of their guidelines, or as their sort of the format for how to judge these banks, how to rate these banks. All right. This I'm not going to. Well, first of all, everything's going in as a classwork grade. This type of thing at this point, it's starting to look a lot like an economics class. So we won't worry really about this. You won't be tested on this, but open market operations. If the Fed sells securities, the money supply decreases. If the Fed buys securities, the money supply increases. If the reserve requirement increases, money supply decreases, vice versa. If the discount rate increases, money decreases, and vice versa. And the same goes for interest on reserves.